Hello and welcome. You're watching KYC. I'm Hersh Sayta, and we've started to pick up on larger trends as well and discuss it with specific companies. And today is one such company. Could this possibly be a larger trend all the way through FY26 and beyond is really the question that we'll be asking. We're going to talk to a microfinance company or predominantly microfinance lending company, and we're going to talk about Satin Creditcare. Why is that so? That is the biggest question, of course, that we'll be asking today. Is the worst over? And if so, what are the trends looking like? Q1, we may not get specific guidance, of course, fully understand that because companies will be on silent period, but we've been able to manage to at least get a perspective as well. That will also go a long way in helping us understand where this goes in terms of opportunity in the microfinance space and whether investing in it is good at this point of time, whether you're finding bargain buys or not. So that's really the first question. The second one, they have exposure in southern facing states, Karnataka being one of them, Tamil Nadu being the other, and therefore are they reducing exposure there? Is credit quality improving in certain pockets? Is growth coming back? So all of those questions around concentration, because they do have a decently large concentration in some states, and that is the other thing that we'll be picking up. The third piece is with regard to rising competition in saturated markets. Now, mind you, everyone's gotten into microfinance in a big way. I'm not saying that microfinance is saturated, but there are certain markets which already look saturated. So is the low-hanging fruit over, or are we going to continue to see growth in the next cycle like the way we saw in the last? Has that at all changed is what I'd want to understand. The fourth one is macro tailwind visible? Recovery in rural, is that visible? Because that could well drive both asset quality, recoveries, as well as how growth kicks in going forward. So we'll try and understand both of those. Fifth piece is goals. FY26 guidance not disclosed. Unlikely that it will get disclosed either because we are still on silent period. But what is the goal like for FY27 and beyond? Let's cut out the clutter for FY26 maybe, look at FY27 and beyond, what is the outlook looking like? And last one, is there over leveraging still in the system? If so, how much? And what are the bureau gaps like? Outside of this, of course, rate cuts, we'll try and understand what that and how that impacts someone like a Satin Creditcare. As well as how is growth impacting the industry as a whole. So we'll try and understand all of those macros. But let's first start off with what the company is all about. I'm not going to take too much time on this, but I'm going to try and keep it as detailed as possible at the same time. NBFC MFI is what this one is. It's basically a regulated lender in the microfinance space and has an NBFC MFI license. Right? Again, not getting into the explanation of that, it lends mainly to low-income women through joint liability groups model. The JLG model, that's what it's called. And what exactly is it? I'll explain that very quickly. So what is the JLG model? Important to understand. A JLG or a joint liability group is a group of individuals who actually form this group to borrow money. Right? So all of them will come together, borrow money, and the group guarantees each other's loans. So they know each other well, and they'll be a guarantor for the other's loans. Typically, it's individuals who may not qualify for your traditional loans, something like a secured loan, someone who already has a decent credit history. So both of those pockets of people would likely not qualify. And therefore, what will happen is you will opt for something like this, a joint liability group, where there is a lesser likelihood for lenders to be worried that they will default on their loans. Obviously, this cycle has shown otherwise, but at least that is the perception, and that reduces the risk to a certain extent that there is little doubt on. Who takes joint liability group loans? Well, it's small farmers, people who don't have, or rather, there is a lack of credit history, people who need to be brought in, financial inclusion. It also enhances social capital, but it's small farmers, entrepreneurs, individuals running small businesses. All of those people are essentially the group that is targeted. when it comes to JLG. Now let's talk about the nature of joint liability group loans. And this will probably explain better as to what a JLG actually warrants. Each individual is responsible for the other's loan as well. So the other making the repayment, you're the guarantor for it. So that's one. Even if one member defaults, others are responsible for payment of the loan. Loans are offered without collateral, so you don't need an underlying collateral for opting for these loans. And it's typical for persons in similar businesses to make a group, and because they'll understand each other's businesses. But this also, of course, leaves you open to the risk that if that business were to be failing, then pretty much all the loans are exposed. It also, Satin in particular, has also diversified into other lending, because this is obviously slightly more risky. So the other lending they do is to housing, MSME, and they provide software as a service, but that's relatively smaller. So we'll probably talk very little to nothing about some of these things. But housing, MSME is large, and we'll talk about that. Around 1,700 odd crore of their loans are housing, MSME. Now let's talk about scale. Geographies. They are in 29 states and union territories. They are in 529 districts. They have around nearly 1,600 branches, 33.5 lakh customers, and the concentration will also come up on your screen. The top 4 states are 56% of the loans. The next 6 are 27%, and then the remaining 19 states are just 17% of the loans. So that's how really the loan mix is structured. Now let's talk about the type of loans that they give out, and that's how the loan mix is. It's microfinance predominant, 87%. Then you have housing finance, secured MSME and retail is just about 6%. And then there's a business book, which is relatively small. But broadly, it's these three. And if you club these two, it's roughly 1,700 crore, nearly, in terms of size. And that one is the one which is growing fast. That's what they're focusing in on. Now, let's talk about metrics. This is a lender, and therefore, the metrics will obviously be slightly more nuanced. For those who have watched us will know. We'll start off with the income statement, the balance sheet, the asset quality, and the key metrics for lenders. We'll break that up in that fashion. Thereafter, we'll look at shareholding, street cred, street coverage, and valuations. And we'll evaluate the company on the basis of these parameters. Let's start off. Let's talk about the income statement. In terms of growth, well, it's been a decent 3-year CAGR. They've done around a 27.5% growth on the net interest income number. Your operating profit too has grown or ballooned 52%. So there's an OPEX play which is playing out on the numbers there with regard to where operating profit is concerned. Your provisioning has gone up, but it's also a tough cycle, and therefore this one is where all of the profit cyclicality will come from. Look at the profitability in FY24, look at the profitability in FY25, and what you'll see is that cyclicality comes in only when there is an asset quality issue, or when there is expected credit loss, which actually translates to provisioning on the income statement. So that's how the income statement shapes up. We're giving this a thumbs up only from a perspective that there is definitely going to be some lumpiness in where credit costs are concerned, but your top line growth and your operating profit growth, plenty of levers to play both of those. Profitable nonetheless, and that's the only possible reason why we're giving this a thumbs up. So we'll give this a thumbs up for now. Let's look at the balance sheet now. And when you see the way in which the balance sheet has moved, we've not seen substantial growth over the last 2 years or so. From 9,000 crore odd in terms of AUM, the AUM has gone only to around 12.5 odd thousand crore. Now that's a decent growth, there's no doubt, but it's a 2-year CAGR that we're taking. So growth has come in, but would you want it to grow faster on a low base? Definitely. Also try and understand it's a bad cycle, and therefore growth has been curtailed to a certain extent. So that's the other thing at play. Now you look at FY23 and 24 and look at the growth there. Nearly 20%, right? Or rather over 20% growth, in fact nearly 30% growth there. And then thereafter you look at FY24 and FY25, there's just growth not visible. It's not even double-digit growth. So that's where some of the concerns start to crop up, that it's a highly cyclical business, but that's the nature of the business. And we'll talk a little bit about that going forward as well. You look at the capital adequacy, fairly healthy in that sense, above 25% across all 3 years. So no concerns with regard to where capital adequacy is concerned. Now let's talk about asset quality for a bit. You see how asset quality has moved over the last 3 years. This is basis the company presentation itself. So we've picked it up straight from there. There's plenty of movement with regard to your NPA ratios. There's no control over that. At least that's what it seems to suggest. We've given this a neutral only from a perspective that it's not ballooned in significant fashion. We've not seen your GNPA go above 5% or 6%. And therefore, we've given this a neutral. It's a bad cycle that it's been through for sure. Asset quality a concern for sure. So that's something that you want to keep on your radar. But that's the nature of the business. Again, that's what I'm trying to say. Microfinance by its very nature is that way. And if you're invested in it, that cyclicality is part of what you're invested in the business for. So, and that builds into valuations as well. So you want to keep in mind all of those factors when you're looking at this particular metric. Now let's talk about key metrics. And again, you'll see some bit of that cyclicality on the ROA. While the margins are fairly steady to a large extent, look at the ROA. Flat or rather near zero at FY23 levels, FY24 sharp rebound, and FY25 at 1.7%. So that's the nature of the business. When you're investing in something relating to microfinance, you'll get very good yields. So you're getting an 18.5 to around a 21% yield on your product, which you'll probably never get anywhere else. But look at the margins as well, nearly 11 to 13% on the margin count as well. So again, it's a very, very healthy margin. You won't see these kind of margins, especially in the NBFC space, in too many places. So what you want to therefore also judge is the fact that you will always have a better margin, but there will always be a credit cost built into the margin, which kind of will impact your ROA, and that the worry is the chunkiness of the credit cost that comes into the margin. It should not dilute your ROA to such an extent that it wavers so much, which is exactly what is happening. But again, to a large extent, that's the nature of the business. But you have to keep in mind that this is very, very high margin to try and build in for that credit cost. Lending is always a business where you have to take care of credit cost with the top line that you're making, and thereafter arrive at your ROA. And if you're able to do a decent ROA even in bad cycles, then that gives you leverage. So that's the way one needs to think of microfinance and lending in general as well. If there is very, very low credit cost on your lending, then of course your margins will be lower, right? And therefore it's a mix of those two, which you have to judge on the basis of. And look at the OPEX to assets as well. There's been a bit of a taper in FY24, which has aided the ROA. We've seen a bump up with regard to cost to assets as well, or rather OPEX to average AUM as well in FY25. So that's how we're looking at all the key metrics. It's a very, very neutral set of numbers that we're seeing. We've given this a neutral as well. More to wait and watch on with regard to consistency of performance. That's something I believe the markets will be looking out for. Let's look at shareholding pattern now. The promoter ownership is around 36%, around nearly 5% owned by FIs. They've sold a bit of stake in March of 25 in terms of that quarter. DIs have bought an equal amount, and the public holds the rest. It's a small company, sub 2,000 crore in market cap. So some things that you need to look out for. Now let's talk about street cred. Last 1 month returns is just 3%. 3 months is around 17%. 6 months is around 8 odd percent, and the 1 year is negative 23%. So there's clear pain there, at least over the last year or so, for those who have invested over the last year. But you look at the last 5 years, it's a doubler. We've again given this one a neutral as well, because the last 5-year performance over the longer term, it's done okay. It's been a doubler in the last 5 years. And we're at the bottom end of the cycle, almost. And we'll find that out, obviously, when we speak with management. Now let's talk about street coverage. There's one buy, there's one hold, there is no sells, 5% upside. One is there are very few people covering the stock, or very few analysts covering the stock. Second is the upside isn't not looking too attractive. Well, unless we get better information from management, we won't be able to understand exactly what is it that is being penciled in which doesn't offer a decent upside? And if it doesn't, then maybe we stay away. What also we have to look for is valuations, and let's pull that up. Look at the way your price to book is currently. It's trading at 0.7 times current. It's trading at 0.6 times 1 year forward. This is basis the two analysts who have made forward projections. And you look at some of the others. This is looking likely the best among all the others in terms of valuations, but you must keep in mind that it's a smaller counter, point number one. It's got less coverage, and therefore the 1 year forward valuation may well get impacted. And point number three is that you want to be cautious in a tough credit cost environment. So all of those three factors, we've been cautious about this, given this a neutral. Let's quickly pull up all the metrics that we've just spoken about and try and sum it up. So income statement, balance sheet, asset quality, key metrics, shareholding, street cred, street coverage, and valuations. And that gets us a rating of 4 out of 8 on our KYC. But let's bring on board Mr. HP Singh, Chairman and Managing Director at Satin Creditcare, joining us live. Welcome, sir. It's a pleasure speaking with you. I want to first understand from you, how is the industry as a whole playing out? Is lending returning? Are you starting to see recoveries trickle through at all? Has the cycle bottomed? Is the worst over?
Oh, yeah, I think, if you look at the asset quality metrics, definitely, I think the worst is over. I think that's probably one positive statement which I would like to enumerate. When I say the worst is over, I probably say that the peak was somewhere last October, November. I think, from there on, I think the asset quality has improved, the collections have improved. And definitely, if you really look at it, the last half of a year, financial year, is always very good in terms of microfinance, because the first half is very, very slow because rains, heat waves, and everything takes a toll on the disbursement and the collection. Now, having said that, I think, for us, if you look at the entire landscape of the industry has not fared very well. And just to give us perspective, I think you explained it very well, and I was looking at that. The matrix, the income statement, everything which you probably brought out to be. We were probably one of the only institution which was 4 quarters in profit. If we give a complete landscape of the last 16 quarters, we've been profitable in the last 16 quarters. Now, that is probably one very big positive in the entire industry. So where we probably are able to see our institution as compared to the other institutions, I think we've been able to handle asset quality, we've been able to handle our credit costs, we've been able to handle our growth. In fact, we are probably one of the only company which would have grown 7% from the last year. If you look at the entire peer group of MFI, everybody has degrown. In fact, the degrowth is far more sharper for a lot of institutions. We in that even phase have grown by about 7%. So I think if you look at the complete mixture of asset quality as well as disbursement as well as our growth, I think we've performed, I think, the best in the entire industry. And that is what I can probably say it right now.
Point taken, Mr. Singh. So things definitely improving. So I know you have stayed away from giving guidance for FY26. Can I push you for a guidance on this forum in terms of growth for FY26? And I'm not talking Q1. Let me make it very, very clear. Growth guidance for FY26. And is there a credit cost guidance I can get for FY26? What's the thought? You've said it'll shrink from 4.5%. How much?
Yeah, I can give you a guidance. We are in the silent period, but the guidance will definitely come in. But the only thing which I can say is that it's going to be positive. That's probably a reply which I would like to place it on record right now. In terms of our credit cost as well as our collections efficiencies, all put together, I think we are at a place where we've actually seen the peak happen probably last year. Now it's a way how we are able to really address that, and my sense is that, even the credit cost, which was about 4.6 to 4.7%, will definitely go down. That's for sure during this FY26, and that is probably two things, which I can put it on the table right now. Now, the guidance will come definitely. I think we said it that it'll come post the first quarter. I think it'll come at that point of time.
Sir, talk to us 3 years. What is the book size going to be maybe 2 to 3 years from now? Now that there is better visibility, at least with regard to asset quality, do you double book in 3 years? Is that a reasonable expectation?
Yeah, I think doubling a book is not what we want to really concentrate upon or look upon. For us, the biggest matrix is your asset quality. I think even if the growth is in, let's say the early teens as such, or whatever it is, I think for us, what is important is our asset quality good enough for us to generate an ROA of about 2.5 to 3%. That's what our final goal is. For us, growth will come because there is technically there's nothing which probably gives us any kind of a reason why we can't grow. We can grow, but the point is, can we grow in a fashion where our credit cost doesn't take a hit, where our GNPs don't go down, where our profitability is related to the ROA, which we really like to put. As I said, 2.5 to 3% ROA. And if I have probably, we have got I think a 6-year horizon, and this is, since we are a listed entity, you can probably see it, see the numbers of all across, 6 years on a trot, even in this cyclical, non-cyclical phases of our, we've maintained an average of about 2% ROA. And 2% ROA for a financial services company, and that to a microfinance company, where the cycles are very, very, very tough to really handle. Last 6 years, average ROA of 2%. I think that's a very huge statement, which I would like to say that, having a 6-year trot of 2% ROA, I think is fairly good for us.
So, Mr. Singh, what gives you the confidence to guide 2.5 to 3% ROA? Where's the kicker going to come from in the next 3 years?
The kicker is, again, since we were practically different from the other peer group, and when the credit cost has definitely hit, I think, double digits also for a lot of players, Over there, if we've been able to be, let's say, we are 2.5, 3 times better than, the peer group, I think, for us, when all this probably dies down, when the cyclical matrix will probably be on a stable level, I think, there for us, it's very easier in terms of our growth as well as our credit costs, as well as based on our asset quality, we'll be able to generate a 2.5 to 3% ROA. Along with that, I would also like to place on record that for us, I think, technology, we are probably one of the institutions which has got a great fallback on technology. For us, technology is like the key. It's an enabler, definitely, yes, but we follow a lot of technology. That's the reason why we opened up our subsidiary, which is a technology company, because for us, we believe that the growth or the future probably for microfinance will also lie, maybe to a large extent, how your technology also enables your acquisition of a customer, your disbursement cycles, as well as your collection efficiency. So I think that's a key matrix also to be looked at.
Mr. Singh, what is giving you the confidence that we've bottomed in terms of asset quality, or rather credit cost? The worst is over. Are you seeing a pickup with regard to rural? Are you seeing better rural income? And what is it that you're doing in terms of geographic concentration?
See, I think, and I'll give a couple of things which probably will lead to it. I think one, the disbursements have started picking up. It was not like the way it was before, because it was an election year last year. It was probably the heat waves are very massive, as well as I think if you look at the complete cyclical stuff, people have degrown, but our disbursements have picked up from there on. Even our collection efficiency are better. Now, if you look at the last quarter of the financial year 25, I think we were probably one of the best ways we could probably do it. Our PAR was completely under control. Collection efficiency of X bucket was close to about 99.8%, which is pretty good if you really look at it. Based on all these factors, and where if you look at the general environment as such, the monsoons are fine at this point of time. I think they're talking of a normal monsoon this year. that also gives us a key insight into that the rural income, the farmer income, as well as agri and agri-allied income will also probably see an uptick. That is also one of the key reasons where kharif crops have been sown properly. I think it's probably 100%, and even the crop acreage has also increased over there. So my sense is, based on all these factors, I think we will probably look at a much better quality and a much better disbursement growth moving ahead from here.
Mr. Singh, I have 30 seconds. A quick take. What changes in the next cycle versus the current? I have just 30 seconds, sir.
So I think, all our focus on credit quality, technology, as well as our acquisition, the way we acquire a customer based on credit bureau and the score systems which we have inherently of our own company, I think, that will give us an edge over probably a lot of people, going forward ahead.
Okay, thank you so much, Mr. Singh, for coming in, speaking with us, giving us that perspective. For me, the headline, essentially, viewers, is that the worst is over with regard to where microfinance is concerned. We're going to see a likely kicker in FY26. That's what he's hinted towards. We'll have to wait and watch as to how Q1 pans out, and thereafter will come the key commentary which markets will quickly start pricing into. So keep your eye out on this one. It's an interesting space. But thanks so much for tuning in. That's all from our side, folks. Thanks for watching.